All right, everyone, thank you for joining us for February's Lunchbox session. I'm going to start off by saying I have a terrible cold going on right now. So if I sneeze or sniffle throughout all of this, I'm so sorry. But I wanted to just quickly introduce our speaker for the day. Thank you for the infamous Lisa Hunt with USX Federal Credit Union. She's going to be our presenter today and talk about demystifying credit scores. I like doing this when I say demystifying. So I'm particularly interested in this topic just because obviously it's always great to keep up with your credit score, especially if you're a business owner or you're just an individual. So this topic really applies to all humans. So Lisa, take it away.
Thanks, Annie. I am very excited to be here, and I am going to be covering a lot of info. So just give me 1 second here while I get my screen share up. Maybe. There we are. Okay. All right. So as Annie mentioned, we talked about credit reports and scores, very exciting. But as Annie mentioned, sincerely, this is something that impacts all of our lives, every single aspect. Can everyone still hear me? It's saying my internet connection is unstable. Are we good still? Yes? Okay, perfect. All right, so a quick disclaimer, because what would a presentation be without a disclaimer? Fair Isaac Corporation scoring model is proprietary to Fair Isaac Corporation. What that means is the algorithm that calculates the scores and all of that, we don't ever get its trade secrets. The points in this presentation are going to be approximate guesstimates, but they are based on upon thousands.
I think we lost Lisa because her bandwidth was low. I had just texted her. So hold on just a second, folks.
Now.
Yeah, do you want to switch over
Good,
to,
bad?
I was going to say, try and switch over to the PNRC 2.4.
Let me see, okay.
I really enjoyed the fact that Lisa's on the other side of my wall. So I literally just banged on the wall and was like,
all right, what about now? Are we good now?
Yep.
Yep.
Okay, all right, let's try the screen share again.
Much better.
All right, did we get the disclaimer? Yes, okay, perfect. So a couple things on credit reports. First, boring laws that actually did have a nice impact on us. 1970 Fair Credit Reporting Act, that was the first law to actually govern credit reports. Who here knows Tracy Armstrong, Welcome Wagon, North Pittsburgh Greeting Company? Raise your hand if I can see you on the screen. So prior to that, they would consult people like the Welcome Wagon lady to see what they thought of you and whether they were going to give you credit. So 1970 put some actual teeth and legalese behind it to govern consumer reporting, credit reports, gave you the right to dispute incorrect information on your credit report. Not to put an age on me, but I graduated college in 2003. Prior to 2003, you were not legally entitled to see your credit report. So you apply for a loan, you get denied, you had no right to see the credit report that was saying, yes, you get the loan, no, you don't. 2003 was when you actually were given the legal right to see each of your credit reports from each of the 3 bureaus. Important thing to remember as we go through this presentation, there is a difference between a credit report and a credit score. They are 2 completely separate things. You have 3 major credit bureaus, Equifax, TransUnion, and Experian. Those 3 bureaus are who collects all of your information. They collect any loan applications, your credit history. They collect anytime you've applied for credit. All of that information is collected by those 3 bureaus. So who here knows where you can get your free credit report? Somebody to say something. Heather, I can see you there.
Free credit.
Where?
freecreditreport.com.
No. There are hundreds upon hundreds of websites out there. I did a Google search today just for fun to see what the first one was. I typed in free credit report, and the first thing that came up was free score online. However, thing to remember, it's not your free credit report. I typed in free credit report. This is why I mentioned there's a difference between reports and scores. This is what came up. Whenever you get something like this, they'll say, we'll give you your credit report, Discover Card, the 3 bureaus, Credit Karma, Credit Sesame, all those places. Most of those places are not actually giving you your legitimate actual free credit report. A lot of those places like this free score online, which says powered by ScoreSense, complete view of your credit delivered in seconds. But check out this part right here. This is a screenshot from the website today. $29.95 a month membership. That's what they want you to sign up for, their credit monitoring. So annualcreditreport.com. Write that down. I'm going to send this presentation to Beth, but write it down because I want you to remember that. Annualcreditreport.com. That is the only source for your free credit reports that is authorized by federal law. Only one. Right there, annualcreditreport.com. Screenshot also grabbed today. See right on it, it says, don't be fooled by lookalikes. There are tons of places out there that want to take advantage of the fact that you know you're entitled to your free credit report, but where do you get it? So make sure to look for this. And then in the bottom, you'll see it's actually brought to you TransUnion, Equifax, and Experian. So that's what you want to look for. When you go to get your free credit report, a couple of things to remember. There's 3 free credit reports, one for each of those bureaus. Whenever you go in and you put in your personal information, it's going to ask you some very personal specific questions. Don't panic as long as you're on this website. If you're on this website, it might say something like, okay, Beth Machine is applying to get her free credit report from TransUnion. It will ask Beth, it looks like you had a student loan and your monthly payment is roughly in the amount of which of the following options. And it will give you 4 or 5 options that one of those options most likely is going to be none of the above. Sometimes that is the correct answer. So keep in mind, it's going to ask you personal information to ensure that you are really who you say you are. And your free credit report is actually 3 separate ones, TransUnion, Equifax, and Experian, one from each of them. So if you're married and you have a lot of joint stuff with your spouse, you can actually technically space it out every 2 or 3 months. And one time get your TransUnion, 2 months later, get your spouse's TransUnion, 2 months later, get your Equifax. It's a nice way to double check and make sure that the information is correct, that there's nothing incorrect on your report. If you have not checked your free credit report recently, and I mean in the last year or so, you should do it. There are so many things that are on that report that can determine if you get a loan, the interest you pay. You're legally entitled to check it. It's important information. So who here has seen their credit report? Raise your hands. I can only see a couple of you if you've actually seen your real report. If you haven't seen your report, there are potentially 5 main sections. First, you have your identifying information. That's your name, your date of birth, your social security number, your addresses that you have lived at, and also your employment history. 2 things to keep track of on the identifying information. If you have a very common name, unfortunately, it's likely you're going to have some incorrect info on there from somebody else with a very common name. Like if your name is Deb Jones, there's chances somebody else that's named Deb Jones, their information might be on there. If your social security number is incorrect, if there's an address that you have never lived at, that might be a sign of identity theft. And don't panic if your employment information is not current and up to date. When I switched jobs from my previous job to the credit union, it took a good 2 years for the credit union to actually show up as my employer. So don't panic if that information is just slightly behind, but the addresses, if you see an incorrect address, that could be a sign you have identity theft. The biggest section of your credit report is going to be your account summary. That right there. That is probably going to be on someone of my age, which I admit I'm 41. I didn't want you to call me old Heather. That's why I said it. My credit report is probably about 27 pages long because that account summary, that chunk of your credit report is every trade line, every account you have ever opened. Every single one is on there. And each one includes the account, the open date, the credit limit, the loan amount, the current balance of the loan or account, the payment terms, and the most important chunk, which is the payment history. The payment history, the last 24 months, is one of the heaviest weights on your credit score. I'm not saying that you're going to skyrocket your score by paying your bills on time every month, but you 110 million% will completely bottom your score out whenever you start to go late on various accounts. Again, paying on time, not going to jump your score super, super high. Paying late can completely kill your score. So that payment history is heavy, heavy weight. Your inquiry section, that's a record of anyone that's requested your credit report over the last 24 months. Anything longer than that, and it will fall off of your credit report. Hopefully, I said potentially you have 5 sections on your credit report. Hopefully you don't have a public records or collection section. That's all negative. If you don't have one on your credit report, yay, that's good. If you do, that's a lien, a bankruptcy, a collection item, such as credit card, utilities, medical bills, anything like that, any judgments, any delinquent child supports, those are all in the public records and collections. There is no positive in that section. If you have that section on your credit report, you want to do what you can to clean that up and get that off. And then the last thing that has unfortunately become much more common is the consumer statement. Has anyone here been the victim of identity theft? I'm not talking credit card fraud. I'm talking actual identity theft where their information was taken and somebody potentially opened up a new account in their name or something like that. Has anybody had that happen? I have. So on my credit report, all 3 of them is a statement that says I was the victim of true identity theft, meaning someone took my social security number and my personal information and tried to open up accounts with it. So that actually just tells the person looking at my credit report that there's a potential that somebody has stolen my identity and I am not who I say I am. That I applied for a loan, but it's actually Heather Kurdick behind that saying I'm Lisa Hunt and I'm applying for a loan. Sorry, Heather, I can see you right next to me. So that's why you're seeing more and more consumer statements. You don't necessarily have one of those, but that is in a lot more credit reports now. So now remember I said difference between report and score. So we talked about the information in the report. That is where the score comes from. Your credit score is a 3-digit number normally, between an average of 300 up to 850. I'm merely saying this because the question has come up. This is not golf. You want to have a higher score in this case. Credit score, better to be higher. Golf, better to be lower score. So if you need to, remember that credit score is the opposite of your golf score. The higher the score, it means the lower the risk you are for not repaying the loan. The lower the risk you are, the lower an interest rate that a financial institution, a mortgage company, or anything are going to charge you. And the lower the interest rate, the more money you're going to save. So pretty simple, higher score, lower risk, gonna pay less money to us. Just some background on scores. The actual score was created in 1956 by Bill Fair and Earl Isaac. If you look at the nice little combination of names, that's where you came up with FICO. But while it was created in the 50s, didn't come into wide use until the 1980s. And that was, again, another way that they could create consistency and equality. So people couldn't just say, you know what, I really like you, Beth. I'm going to give you a better interest rate. Heather, not as much, going to give you a worse interest rate. It was designed to be able to take subjectivity out of the equation. Again, it's just used by lenders to assess how likely a person is to repay their debt back to us. The score is calculated based on the information that's provided by those 3 bureaus I mentioned, Equifax, Experian, and TransUnion. And it's very important to remember with all of the information out there now, everything on the internet, that not every score is a FICO score. So kind of think along the lines of whenever you have a cold, do you reach for a Kleenex or do you reach for a tissue? Not every tissue is a Kleenex, but that's what we call them. First in the market, FICO, therefore we refer to every score as a FICO score. Not every score is a FICO score. And it's also important to remember that not every score is one that lenders use. If I was more technologically savvy, I'd go back to that screen that I showed you of the free score online. That score they're talking about, somewhere in the fine print there, it's going to call it a consumer score or an educational score, pretty much not one a lender uses. It's just a snapshot in time of your credit risk right now. So right now, if someone were to pull my credit, it's going to be a certain number. Tomorrow I have a bill due for my mortgage. I pay my mortgage amount is going to go down. So 5 days from now, if they pull my credit again, my score is going to be different. So every time you make a change to your credit, you open a new account, you apply for a loan, you pay for a bill, anything at all like that, it's changing your credit. So has anybody seen the commercial? I think it was for freescore.com, where the girl got her credit score tattooed and the person says, you know, that can change all the time. It's a really good commercial. I love it. Makes me laugh. But that's the entire point behind your credit score. It changes all the time. I mentioned previously that these are proprietary formulas. I work for USX Credit Union. When you apply for a loan for us and we get your credit, we don't have the calculation and punch in the information and get the numbers that way. We literally pay, and then Equifax, Experian, or TransUnion, depending upon who we're pulling from, sends us your score. They don't send us the algorithm. It is a proprietary formula. They keep a better grip on that more than KFC and their secret recipe. No financial institution has the information for these proprietary formulas outside of FICO. There are literally more than 50 different FICO algorithms. So depending upon if you're applying for an auto, you're applying for a credit card, you're applying for a mortgage, there are countless algorithms just on FICO alone. Now, FICO is one company, it's a private company. I mentioned the three bureaus a number of times, Equifax, Experian, and TransUnion. Those three bureaus decided, well, we don't just want to supply the information, we want to actually create the algorithm as well too. So in 2006, they created a company called VantageScore that they wanted to try to compete with FICO. They've actually grown a little bit. They're roughly about 15% of the market now. However, whenever you're looking at what type of a score a place is offering you, if it says VantageScore on one of those consumer education sites, it's probably even further away from your FICO score than a consumer FICO score. So just keep in mind that there's different places that can also offer it beyond FICO. Now, multiple scores can be a number of different reasons. And one of those is because of the way that lenders and businesses actually report the information to the credit reporting agencies. So using USX as an example, again, we might only report to Experian. We might only report to Experian and Equifax, or we might report to all three. But going down to the time frame in which information is recorded, Equifax might put that information in on the 1st of the month. Experian might put it in on the 15th, and TransUnion might put it in on the 30th of the month. So depending upon when the bureaus record that information, that can also give you a different score as well too. Has everybody seen this pie chart's fairly common? You see it a lot of times whenever people talk about the breakdown of credit scores. But again, proprietary information, so we try to do the best we can with what we can provide. This just gives you the breakdown of roughly the percentages of what goes into your score. So the biggest chunk there is payment history. I mentioned I circled it on what was in your credit report, that account history section. 35% of your credit score is how you pay your bills. So account payment information, if you have delinquencies, if you have collections, how severe the delinquency is. You lose more points if your bill is 90 days past due than if your bill is 60 days past due than if your bill is 30 days past due. So using a Kohl's card as an example, if you have a $30 Kohl's payment and it's due on February 1 and you don't pay it, and then your due date for March month comes around and you still don't pay it, so now you're 30 days late on your bill, that's going to knock 60 points off of your credit score. So one $30 payment will knock 60 points off of your credit score. Now you'll get those points back as soon as you bring the account current. You get about 2/3 of those points back, but the remaining 1/3 takes you about 12 to 18 months to gain those back. So that's just one account. What if you go from 30 days to 60 days late? You lose an additional 15 points off your score. If you go to 90 days late, you're up to a total of 90 points off of your score just for paying that one Kohl's charge late. It doesn't matter the amount. You've gone 90 days late. And if you go to collections, a collection account, once it hits your credit score, that's about 50 points just for the collection. So one account can take you from, say you started a 750. One account can take you from a 750 using those numbers down to a 600 credit score just by letting it go all the way to collections. The amount of money past due, that's one. The number of past due items can dramatically hurt your credit. And then as a positive, because we like to end on a positive, the number of accounts showing that you are current and you have no late payments, that is actually a positive. You'll gain 1 point every month or two for positive payment history. So paying on time. Amounts owed is another huge chunk. Whenever you're looking at your credit, has anybody seen whenever they've looked at their credit and it said something about your revolving balances proportion is too high? If you have a $10,000 credit card, ideally you want to keep any revolving balances like that less than 30%. So $10,000 credit at any given time, you really don't want to have $3,000 or more charged up on that. They want to see for the best weight on your score, less than 30% of your revolving credit is being used. What that means for you is whenever you get something that says, congratulations, your payment history is great, good job, we're going to raise your credit limit. Tell them thank you and take it. I know a ton of people that say, oh, I'm not going to take that. I don't want that extra credit there. It's actually helping you. It's keeping your proportional balances lower. Just don't charge it up. If you have a $5,000 card and they bump you up to $10,000 credit limit, don't go out and charge up an additional $5,000. Keep that open credit. It's helping you. The easiest way to explain it is if you take a pebble and toss it into a cup of water, that water is going to splash everywhere and spill all over the place. If you take that same pebble and put it in a giant lake, it's barely going to make a ripple. It's the same idea on a credit card. If you have a $1,000 credit limit and your hot water tank goes and you have to go out and get a new hot water tank and pay for it installed, you're going to charge up that entire card. You're going to have the full $1,000 limit used versus if you have a $10,000 limit, as opposed to using 100% of your limit, 1,000 out of 10,000, 10%, going to weigh much, much, much lighter on your credit. So that's 65% of your score there. Capacity, that's a big chunk of the amounts owed. So take your total balances on your revolving debt. That's any credit cards. And yes, that is also your home equity lines of credit. And then divide that between your total limits reported on your revolving credit. That's going to give you your percentage of your capacity used. And again, you want that less than 30%. Length of credit history is important. If you have a card that you have had since you were 18 years old, don't ever, 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 ever close it. Keep it open. Keep it as your longest credit account because that will actually be a huge help to you. Also, how long since you've used your last cards. You want to use your cards at least once every 10 months. If you have a card that you haven't used very often, you want to use it roughly every 10 months to ensure that it stays open. If you don't use a card, they're going to close it. And then that's going to impact your credit history. And also it's going to impact the amount of capacity you have. New credit, how many new accounts you have, how long it has been since you've opened it. If you've had a ton of recent inquiries, if you're a young person, 17, 18, 19 years old, you don't have a lot of credit, you don't want to go out and apply for 25 new cards. You don't want to go out and apply for 3 or 4 new credit cards plus an auto loan. When a lender looks and sees that you've applied for a lot of credit in a short period of time, that's going to tend to throw up warning flags that says you might be having some issues. On the flip side, if you have had a very lengthy credit file, it's not going to weigh as heavy, but they're still going to look and see that you applied for 6 credit cards in the last 2 months. Hey, what's going on? Are you possibly having some financial issues? Now, there's a question that comes up a lot about inquiries. There's 2 types of inquiries. So if you apply for credit, you come to USX Federal Credit Union and you apply for our Visa credit card, hand in your application, it's signed and ready to go. That is a hard pull on your credit. That will impact your credit. Every inquiry is about 5 points off of your score. If you get the loan or the card, so that's a trade line, it's another 10 points. So an application that gets you a new loan is roughly 15 points off your score. You'll get those back about 1 to 2 points a month over the next 12 months. So that does impact your score. However, who here has gotten a envelope in the mail that says, hey, you're pre-approved for $25,000 at XYZ car dealer? Anybody gotten those? I get them all the time. Those are soft pulls, involuntary inquiries. They do not impact your credit score. However, the instant you take that same paper and you fill it out and sign it and say you want credit and send it in, that turns into a voluntary, a hard inquiry that it is going to be the 5 points and then the additional 10 if you get the loan. So keep that in mind, that you can take an involuntary inquiry and actually turn it into a hard pull on your credit. Alike inquiries are if you go to the auto dealer and you apply for a loan there and you come back and they've sent it out to 15 different places. Really bad, right? I said that's going to be 5 points for every inquiry. That's terrible. It's going to tank your score. No. Certain loans, autos, student loans, and mortgages, they want you to rate shop. Depending upon the algorithm that they are using, the version of FICO that they have, generally 30 to 45 days is what they say, but you want to keep it about 2 to 3 weeks max. Even on mortgages, you want to try to keep it as compact as possible, because what happens is the algorithm recognizes when the loan appears, all of those inquiries were only for that one loan. So it actually only calculates it as one inquiry. You will still see every single one under that inquiry section on your report. It'll list every single place, but it calculates it only as one inquiry. So the 5 points, even for those multiple places, and then the 10 points for the loan. And then types of credit used. They want to see that you can manage revolving credit, installment loans, mortgages. They want to see you can handle different types of credit. So whenever you get your score, regardless of what your score is, at the very, very end, after you get senior credit, whenever you've applied for a credit card through USX Federal Credit Union, we'll send you your score in the mail explaining we pulled your credit. Here's your credit score. This is what your score was. And it will give score reasons up to 5 that will be listed there. Now, what those are is those are technically why your credit score is not higher, why your credit score is not perfect at an 850. However, another way to look at them whenever you look at that is those are actually ways that you can improve your credit. It'll say things like your revolving balances are too high. Okay, pay your revolving balances down. Recent delinquency, pay your bills on time. So while it's the reasons why your score isn't higher, flip it over to a positive. Those are how your credit score can actually be improved. Things that are not considered in your credit score: age, gender, race, religion, nationality, marital status. Your score doesn't matter if you're married or single. A lot of people think when they get married, their scores combine. That doesn't happen. What more frequently happens is people get a lot of joint credit, and that joint credit tends to put their scores closer together. But being married or single has no impact on your credit score. Your salary, your occupation, your title, your employer, when you started work there, where you live, that does not have any impact on your credit score. Here's the most important part, because this is where it really impacts our lives. What do lenders use credit scores for, and how does it impact us? So as a lender, we use your score to determine how likely you are to pay us. And by law, we price your loan based upon that credit score. So even though I love Beth a lot and she's amazing, if she's had some bumps in the road and she comes in and she applies for a loan and she gets the loan with us and her score is a 625, it's not, I have no clue what Beth's score is, just a disclaimer. Assuming it's a 625, even though Beth is amazing, by law, we have to price her loan, i.e. her interest rate is what our internal matrix says her 625 score is. Even though I really like Beth, Beth can't slide me a 20 or get me some more coffee and I'll give her a better interest rate. If we were to price the loan based upon arbitrary findings, just decisions that, oh, we like that person, we're going to do it, we would be subject to lawsuits. So that is what a score is used. How likely are you to repay us? And here's the interest rate you're going to get. In the eyes of the lender, if you're an 800 or above, you have an excellent credit score. You have an absolutely outstanding credit score. If you have a score above 700, you are still very outstanding. That's a very, very good score, particularly when you get 730 and above. That's a really, really good score. Going between 600 and 700, from 700 working your way down, it tends to get very ticky-tacky. 700 still okay, and you get into the 690s, 680s, your score is typically not very stable. One late payment, one high charge on your card can drop you down. And then when you get typically below 650, you're looking into very poor scores. 600 and under, you're looking at what is called subprime, and chances are good that not only will you not get a loan, but if you do, unfortunately, you're probably going to be paying 18+% at a minimum. But an important thing to remember is that while we've just spent a lot of time talking about scores, there are many slices in your financial pie. I'm actually really hungry. That pie looks really good. All your income and assets are not listed in your credit report. So you could have amazing credit, but you could have no savings or no income. On the flip side, you could have very bad credit. You've had some bumps in the road, but you've made changes and now you're very wealthy. You just don't know how to improve your credit. So you want to remember that your credit score, while very, very important, is not the only thing that a lender is going to look at. We're going to look at the amount of debt that you have, your total debt, everything you owe versus your income. We're also going to look at the amount of unsecured debt that you have versus your income. Unsecured debt are credit cards, personal loans, student loans, things like that. We're going to look at your overall credit history. We will look at your employment history, and we will also look at your length of residence. So again, keep in mind, not talking about what's in your credit score. I'm talking about what all a lender is going to look at to determine if they're going to give you a loan. These two ratios are very, very important, and it's something that you should honestly, genuinely take a look at, and you should teach your kids how to calculate these out too. The first one is your debt to income ratio. You're going to take your total monthly payments. That includes your house payment, your student loans, things along those lines. You're going to take your total monthly payments and you're going to divide that between your monthly gross income. That's your monthly income pre-tax. Key point to remember is if you get paid bi-weekly, you actually need to do a calculation on your salary. You need to take your bi-weekly amount that you get pre-tax, multiply that by 26, because that's how many pay periods are in a 52-week year, and then divide that by 12. That's going to give you your monthly gross income. If you're calculating just by taking 2 biweekly paychecks, you are actually overestimating your debt to income. You're actually putting it higher than it really is. Most lenders look for a debt to income that is not above 40%. Your unsecured debt to income has become much, much more prevalent. And unfortunately, I just looked at some stats today, but since the pandemic, as a country, the US unsecured debt to income has risen really, really high. It's at its highest levels ever in our country's history now. So please keep in mind, if your unsecured debt to income is really high and you're contributing to that, you might want to look at paying your credit cards down. So you take your unsecured debt to income, you take your total revolving balances. Those are your credit cards, and those are also any home equity lines of credit or personal lines of credit that you have. So your revolving balances, and divide that by your annual gross income. So that's your yearly salary pre-tax. Again, same thing. If you get paid bi-weekly, multiply by 26, that's your annual gross income. A good unsecured debt to income we like to see is less than 25%. So again, keep in mind, these are not calculated in your credit score, but as lenders, we do use those in the decision-making process. I like numbers. Who likes numbers? Numbers are awesome. This is just to give you an idea of one loan. So I did this today. I looked up what the average new car loan is today. $47,000. KellyBlueBook.com tracks that. And actually it was December 2021. The average new car price in the US that people took a loan for, $47,077. So using someone that has a less than 600 score versus a 700 credit score, I took that $47,000 new car loan, average cost of a car today in the US, 72-month term, used an 18% rate versus a 4% rate. And looking at the payment there, $1,071 versus $735. if you have a bad credit score, one auto loan using the new car average price today will cost you $77,000 for a car versus $52,943.35. One loan. You're talking about $25,000 difference. Going even higher, 700 versus an 800 plus score, a little bit less dramatic with the numbers, but you're still looking at a difference of $52,900 versus $49,900. So you're still talking about a difference of $42 a month versus $3,000 over the course of the loan. Now, most of us here, when I saw that number, I about died. That's more than I paid for my college education, 4 years at a private school 20 years ago. But I wanted to show you the real numbers. That is, again, December 2021. That is the average cost of a new car. So for those of us that would never spend that on a new car unless they were millionaires, I'm one of those people. I also went to a $25,000 loan. A little bit more able to stomach that amount, but still look at those numbers, 18% versus 4%, less than 600 score versus a 700 score. You're still talking about the difference. So that same $25,000 car is going to cost you $41,000 versus $28,000 if you haven't taken care of your credit. True or false? I mentioned we're going to do this. So we can just do this, and if you just want to maybe write it down, I'll give you a few seconds for each one. True or false? Your score is going to drop if you check your credit report. Correct answer is false. Your score will not drop if you check your credit report at annualcreditreport.com. True or false? Close an old account. It's going to improve your credit score. False. Keep your old accounts open. Closing those old accounts are going to shorten your credit history, and it's also going to lower the amount of available credit that you have. What about if you pay off a negative record? Comes off your credit report? You have something negative, you pay it off, what happens? Does it? So true, it's removed from credit report. False, it's not removed from your credit report.
We have true and false responses.
Oh, well, the correct answer on that is false. Once you pay off a negative record, yes, it helps your credit because you have brought it current. That's good. However, it stays on your credit report. It's part of your history. It's on there for up to 7 years. Ooh, parents, if you co-sign, being a co-signer doesn't make you responsible for the account.
False.
True or false?
Other falses.
That is false. If you co-sign on anyone's loan and they decide to stop paying, not only are you legally responsible for that debt, but guess what? If nobody makes the payments, it hurts your credit too. Here's where we get tricky. Being an authorized user does not make you responsible for the account. True or false?
We have some people saying it's true.
So if you are an authorized user, that is true. If you are only an authorized signer, you can charge up that card. You can do whatever you want. You are not legally responsible for that debt. Small asterisk there. I take no responsibility if you do that and your parents want to kill you. So from a legal standpoint, you are not responsible for that debt. From other standpoints, I say nothing. Now, if you pay off your credit cards every month, that means you have a good score. True or false?
We have some true, some false.
That answer is false. Going back to way at the beginning, multiple time frames depending upon when the information is applied. Ideally, that would mean you would have a good score, but if you just charged up $10,000 and your score is pulled the next day and you haven't paid it off yet, your score is going to reflect you have $10,000 charged up. So yes, it's fantastic. Pay your cards off every month if you can. Just keep in mind, if you know your score is going to be pulled, don't touch your cards for at least 30 to 60 days. Don't charge anything on them, pay them off as much as you can.
It's that percentage of debt to how much you use out of that.
Capacity,
limit.
capacity and how much you have charged up, and so again, pay them off every month, but keep in mind time frame can impact that. And then last, true or false, shopping rates hurts your credit score. True or false?
We're seeing falses.
That is correct. False. It does not hurt your score. Keeping in mind, keep it within that time frame, 2 to 3 weeks. If you're doing that over 6 months, yes, it will hurt your score. The algorithm can't recognize out 6 months. But for auto loans, for student loans, and for mortgages, shopping rates, that's what we want you to do. So just some information, again, where you get your free credit reports, annualcreditreport.com. That is the only place authorized by federal law. Anywhere else says it, unless there's new legislation, they are lying. There is great information on myfico.com, equifax.com, experian.com, transunion.com. Anyone with a laptop and an internet connection now can create a blog. It is vital that whenever you are looking up information, you ensure it's coming from a good quality source. These are all good quality sources that have information that is actually true and factual and not subjective. You can also opt out of those pre-approved credit card offers. It's a lot safer. If you don't want to worry about doing it, just please make sure you have a very, very good shredder at home, because it would be very easy for me to drive past Melanie's house and take those out of the garbage and fill those out and send them in and get cards in Melanie's name. So if you don't opt out of them, please make sure to shred them. Beware of credit repair agencies. Has anyone seen those places where they say they guarantee I'm going to improve your credit? 30 days, I will improve your credit. 90 days, you will have a much better credit score. Those are completely legal services that will charge you, no exaggeration, thousands of dollars to do things that you can do yourself. And technically what they do for the most part is actually very unethical. They flood the credit bureaus with letters disputing every negative thing on your credit report. And by law, the credit bureaus have to respond within 30 days. If they don't, they have to remove that information from your credit report. But here's the problem. Once they get around, these are live people reading those disputes. Once they get around to reading the dispute and seeing that Beth disputed every single thing on her credit report, but well, she really was 6 months late on her mortgage, and she really was 30 days late on this, they can legally put those all back on her credit report. And remember what I said about the most recent 24-month history? So you get that small bump that you paid thousands of dollars for. And then when the information goes back on, it's like it's a new delinquency. So your credit is most often worse than when you started. You can legally contact the creditors and the credit bureaus and fix inaccurate information on your reports. You do not have to pay someone to do it. You are entitled to fix the legitimate errors. That legislation I mentioned earlier, that entitles you to do it. 40% of the US population, yet another stat that I double checked today, 40% of the US population has an error on their credit report. And they're estimating that of that 40%, somewhere between 10 and 20% have a significant error, that meaning it's significantly costing you points on your credit. So if you don't have a bureau, a credit agency, or an ID theft protection plan that fixes this for you, you can yourself send copies, you can check records, you can document your claim, and you can get the legitimate errors fixed on your credit report. If you go to any of those websites that I listed previously, it has the information, and you can do that online as well. You just want to keep records of what you're disputing and make sure that it gets taken care of. There could be errors such as your wrong name, your incorrect address, your social security number actually could be accidentally off by one number in your personal information. There could be closed accounts that are reporting as open or vice versa. There could be accounts that are showing as late when you weren't delinquent. I actually had one of my student loans double reporting, meaning that it was actually showing up twice on my credit report. So it was showing up an additional $10,000 in debt that I really actually was not in debt with. There could just be information that has incorrect credit limits or incorrect balances, which will impact your score. So take the time to fix legitimate errors on your reports.
Hey, I have 2 questions for you, Lisa.
Yes.
One is from Alicia. She said, I did not have a mortgage or a car payment and was told that not having that kind of debt will affect my credit report. Is that true?
It can. It definitely can. It's a small amount. It's that balance. It's that mix of credit, about 10%. As long as you have other types of credit, might not hurt to maybe have a small installment loan or maybe a couple of credit cards, definitely. But as long as you have some credit, the thing that you don't want to have happen is what you see a lot of people that have paid off all their debt. Eventually, all your stuff kind of falls off. And then you have people that haven't had debt and have paid everything off. And 15 years down the road, they have no credit. They don't have any credit because they haven't charged anything for 10, 15, 20 years. So you want to make sure that even if you don't have a mortgage, you don't have an auto, you can get a small installment loan. You can keep a couple of credit cards. For identity theft purposes. At some point, your credit card will get hacked. I'm very sorry if you were not aware of that. At some point, you will be part of a data breach and you will need to get a new card. You really want to have at least 2 different cards, maybe 3 if you're really, really cautious. But that way, whenever your one card is hacked and needs closed and to get a new one, you'll have the other one there as well. It also helps your credit with having several trade lines there.
The second question is, do they pull your credit and does it take a hit for limit increases? Like, I think Heather was asking, when the credit card notifies you that they're increasing your limit, does that affect your credit report?
It all depends. They'll tell you if it was a hard pull or a soft pull. Most often, if you ask for it, we went and we purchased a new washer dryer and a new stove. And the limit that I had for my Home Depot card, because I wanted to get the special rate, the limit that I had for that was not high enough to get all of that. So I called and I asked them to increase my limit. That was a hard pull. So they told me we'll have to pull your credit. Yes, that'll be a hard pull. For another card that I have, if you get the notification that says, please update your income every so often on that, I make sure my income is up to date. They just did a soft pull, took a look at my income and what I had and raised my credit limit that way. So it all depends. I hate those answers, but that is a lot of times with credit. If you ask them to raise it, then a lot of times it's going to be a hard pull. But on the ones where they just say, thanks for your payment history, you've done really good, it's frequently a soft pull where it doesn't impact your credit.
And Melanie, I think, had a question. She raised her hand.
Yeah, so I have a 6-year-old, and not that I'm trying to give him a credit card, but I put him as an authorized user on one of my good standing cards to hopefully have good credit by the time he's, 18. And my question is, should I activate the credit card that came, or can I leave it not activated? Like you were kind of mentioning about the if you don't use the card, but I use mine, so does it matter?
So there's 2 parts to that, and I'm glad you asked that. So the not activating the card, as long as you're using yours, that's fine for the actual account. But here's the thing with authorized user, because it's people figured out that by adding an authorized user to their card, so Beth has amazing credit and my credit's not so good. Beth says, you know what, I'm going to add you as an authorized user to help you bump your credit. So people figured that out. And there were companies that started establishing where pretty much people with good credit were renting their good credit and having people added as authorized signers to their cards to have it go onto their credit to help bump their credit. So in response, it took about a year or 2, but the credit bureaus actually now, when someone is removed as an authorized user, they lose all of that credit history. It doesn't stay on. So it's good that you're helping him build it now, but make sure whenever he gets to that 17, 18 years, you want to get him his own card. Probably be a tiny little limit, $200-300. That's fine. That's all he needs. But that will be in his name, because once you remove him as an authorized user, he'll lose that history. Okay. So, and not activating his card doesn't do anything as long as you're using yours. You might constantly get reminders, you haven't activated this card, you haven't activated this card. But outside of that, it's not going to impact.
And will that stay as his credit history? You know, that's what I was trying to build really, was the history part of it, going through the whole mortgage thing with my home. Like, how long have you had these things? And I never knew that, you know, my parents could have opened something and not done anything really but be in good standing. So will that help?
It will, until you remove him from it. Once you remove him as an authorized user, he loses all that history. So it would come off of his report as if he never had it. So that's why once he's old enough.
Thank you.
Couple tips just to cover, as I mentioned, payment history, pay your bills on time. And by on time, I mean several days early. Who here knows what time their bills are due? Another true or false? Who here thinks there's a time that your bills are due? True, there's a time your bills are due. False, there's not.
True.
The answer is true. Take a look at some point, go into one of your credit cards. They tend to be the most ones. Go into your online banking and look at your statement. See what time it says your payment has to be received. There is a due time on your payment that if your due time is 3 p.m. on February 9th and you pay it at 4 p.m. February 9th, your payment's late. So pay your bills on time, ideally a couple of days in advance. Fun fact for your credit cards. If your credit card is due on February 28th and your bill just generated, saying your bill is due February 28th, if you pay your bill today, that lowers the average daily balance of your credit card and you will pay less interest card on February 28th. So the earlier you pay your bills, especially on revolving debt, the less you're going to pay in interest. If you've missed payments, get current and stay current. I mentioned that positive payments will not skyrocket your score. Late payments will 100% tank your score. Keep in mind, you pay off a collection account. It's not coming off of your credit report. If you are having trouble making ends meet, and I can't stress this enough, we are still hopefully at the tail end of a global pandemic where I think every single person in the world had some type of financial issue, whether loss of job, extra bills, higher cost, whatever it is. Do not bury your head in the sand and don't communicate with your people that you owe money to. I'm not talking about the mafia. If you owe them, that's on your own. But otherwise, your actual legal creditors, your credit union, your mortgage place, your auto loan place, anything like that. If you are going to have issues, if you think you might, call them. I'm not saying they can do anything to help, but if you don't communicate with them, they can't help you. A lot of times there might be programs that can help, things that you can put a pause on to avoid impacting your credit and to keep yourself in good standing with your lenders and with your creditors. So don't bury your head in the sand. Contact your creditors if you might have issues, if you start to have issues, if something happens. Keep your balances low. Pay off your debt rather than moving it around from 0% card to 0% card to personal loan. Don't close your unused credit cards as a short-term strategy to raise your score. Remember, that's more available balance and that's a longer credit history if you don't close them. And again, don't do the opposite. Don't open a whole bunch of new cards you don't need just to increase your available credit, because you're also going to shorten your credit history. If you've only been managing credit for a short time, if you don't have a lot of credit, don't open a lot of new accounts in a short period of time. Young people can tank their credit if they go out and apply for a whole bunch of credit in a short period of time. Do your rate shopping. If you have had problems, you can reestablish your credit without going to one of those credit repair agencies that's going to charge you thousands of dollars. Use it as needed. Manage your credit card responsibly. I can't talk today, sorry, responsibly. And keep in mind that closing an account is not going to make it go away. So just a couple last things. While it's entirely possible to live with no debt and have no credit cards or anything like that, people love Dave Ramsey, he's fabulous. Unfortunately, a lot of us need to take out loans. So keep in mind, there is a difference between good debt and bad debt. Good debt, something that's going to grow in value, generate long-term income, maybe a new certificate program, college education, purchasing a new auto, buying your home. Those are all good things that will hopefully, if you've done them correctly, generate long-term value. Going out and charging up $300 pair of shoes because they're super fun, not going to generate long-term value.
Come on, Lisa. You know you and I love shoes.
Exactly. That's what you want to pay for cash. You don't want to charge those things. A couple of benefits, if you haven't picked up on them, to improving your score, you're going to get lower interest rates. You're going to get your credit approvals faster. You're going to have either no deposits or reduced deposits required by your utilities, by your cell phone companies, things like that. Real estate rentals. If you are somebody that's renting, a good credit score is important to making sure that you can qualify for that real estate rental. You'll get better card offers, better loan offers, better mortgage offers. And if you didn't know it, your auto insurance, your homeowner's insurance, your life insurance, guess what? They check your credit too. And that impacts the rate you pay as well. So keeping your credit score good will actually help you lower your insurance premiums too. So the bottom line is protect and manage your credit. It'll save you money. Any other questions?
Wow. Okay, guys, exactly 1 o'clock. Great job, Lisa.
That's
I've
perfect.
listened- I've listened to this presentation.
Level.
I know.